Welcome to Campus Exonerated, NJIT's pre-law society radio show. This is a general disclaimer that the views and opinions expressed by Liz Finnegan, aka me, the host of the show, are solely my own and do not represent the views, opinions, or official stance of the New Jersey Institute of Technology or its community. The content of the show is for informational purposes only and should not be attributed to NJIT or its affiliates. Listeners are encouraged to form their own opinions and seek additional sources of information to make informed decisions. Anyway, so today is election day in New Jersey. So if you haven't voted yet, go ahead out and vote if you have time. I know it's difficult sometimes to make the time to vote, but usually it is a good idea. But today's show isn't about Election Day. Today's show will be discussing the student debt crisis. I know a lot of students struggle with student debt, and even if you are a current student now and you're not paying off your loans currently, you may have to do that in the near future. And so I just wanted to give a brief show just explaining what's been going on, and because it's been in the news a lot, and it's been prominent in the last election and the coming up election for next year. So I'm just going to define a couple terms in case people don't know much about loans. Personally, I take a class called Math of Finance 1, so even though I had a general idea of what loans are, it's still a good idea to get some terms defined clearly for us. So right now we're just going to discuss a bit of borrowing. When someone needs money for like a specific purpose, they apply for a loan from a lender. It could be a bank, credit union, online lender, or financial institution. And then the borrower requests a certain amount of money. In this case, it would be student loans. There's a lending agreement that the lender provides the borrower with the sum of money, and then both parties enter a legal contract outlining like the terms and conditions of the loan. The agreement that you sign specifies the amount borrowed, the interest rate charged, a repayment schedule, and any collateral. So interest rates can be fixed. They can stay constant over the loan term, or variable, which fluctuates on market conditions, which typically isn't a federal loan deal, but we'll get more into that later. Repayment, borrower is required to pay the loan amount in installments according to the schedule that's in the lender agreement. Repayment schedules can vary monthly. They can vary monthly, bi-monthly, or per a different arrangement. And then there is a big impact on credit. Repaying the loan can positively impact the borrower's credit score. However, failure to repay the loan can negatively impact it. It might lead to further financial and legal consequences. So right now, America has about $1.77 trillion in debt from the student loans. The majority of these are in government federal student loans. These are loans provided by the government, such as direct subsidized loans, direct unsubsidized loans, direct plus loans. They have fixed interest rates usually and offer various repayment plans and benefits, such as income-driven repayment options and loan forgiveness programs. Otherwise, I think there's about 7.5% of the total debt is in private student loans, which is offered by banks, credit unions, other financial institutions. They typically have variable interest rates and require like a credit check or a cosigner. So that might be like your parent who cosigns with you just to So the bank will give you the money in order to pay back your student debt. So the terms and conditions vary widely. So when did the government get into the habit of giving student loans? That started mainly with the Higher Education Act of 1965. It had several titles, but that were in the bill, but they gave grants to states for post-secondary education. It allocated federal funds to state governments to enhance higher education opportunities and support post-secondary education initiatives within each state. It has student assistance. It established scholarship, grant, and loan programs to assist students, including Basic Educational Opportunity Grant Program, or Pell Grants, and federally guaranteed student loan programs. It also did institutional aid. This part provided financial support to institutions of higher education, specifically historically black colleges and universities, HBCUs, and other minority-serving institutions. It supported educational centers and services, and also teacher training and development. I do want to go a bit into Pell Grants because I know that's a big focus currently of Biden's plan for giving students loans based on Pell Grant recipients. So Pell Grants are need-based grants provided by the U.S. government to eligible undergraduate students, primarily those with low income. Unlike loans, Pell Grants do not require repayment. The amount awarded depends on financial need, cost of attendance, status as a full-time or part-time student, and plans to attend school for a full academic year or less. Maximum Pell Grants are over $6,000 per academic year, but the actual amount can change annually. So basically, the government gets a lot of benefits for funding student loans because supporting higher education through loans contributes to a more educated workforce. So in turn, that leads to higher earning potential, increased tax revenues, and economic growth. Workforce development. A well-educated workforce is an integral part of a country's competitiveness in the global economy. We're increasing the skilled labor in our country by providing more opportunities to get higher education. There's reduced reliance on social programs because with higher education, individuals typically have better jobs prospects. Thus, they're reducing the dependence on social welfare programs, and then lessening the burden on the government to supply more money for that. And then it does, providing loans does increase, it can be a source of revenue for the government because of the interest rates. And theoretically, if all borrowers pay all their loans back, then the government will get all their money back plus the interest. And then there's also like cultural and social development. Higher education generally leads to increased civic engagement, improved health outcomes, and a more informed society, which is all important for a competitive global nation like the United States. But what's been going on in the past few years is that due to the COVID pandemic, in March 2020, a pause on federal student loan repayments was implemented by the U.S. government. So that meant several things. For borrowers, it meant a suspension of loan payments. Borrowers were not required to make payments on their federal student loans during the pause. This was to ease the financial burden on individuals, especially those who lost their jobs during the pandemic or were facing economic challenges in the pandemic. The government set interest rates on federal student loans to 0%. That meant that the borrowers did not accrue interest on the loans during the suspensions period. So they were not required to pay, and they weren't required to pay it back later in terms of interest that they had. There was also a halt on collections on defaulted loans, just because if you were defaulting on your student loans, you were already facing pretty significant financial hardship if you couldn't afford to pay them back. So they decided to stop collections. So for the government, they absorbed the financial impact of that 0% interest rate and the suspension. The pause was supposed to provide relief to borrowers, reducing default rates and improving the likelihood of successful loan repayments in the future. Because a more financially stable borrower will be more likely to repay the loan afterwards. But the student loan debt has been a problem, not just in the last couple of years, in which people were facing economic hardship because of the COVID pandemic. It's just in the past 15 years, the total student debt in the U.S. has nearly tripled, from more than $619 billion in the first quarter of 2008 to more than $1.77 trillion in the first quarter of 2023. So with this increased debt rising, average wages have fallen. Many borrowers struggle to pay their student loans. And due to that, they're unable to pursue like other life goals. So like that's why many young people are like not starting their families or not being able to like afford houses, which is different compared to like our previous generations, like boomers, who were able to start a family young or were able to qualify for a mortgage on their house. And so this overwhelming load of debt just tumbles more and more as borrowers can't afford to pay back. There's too much debt, and it stalls like economic development. And then there's also the problem with some student loan borrowers leave school without completing a degree. So that leads them to having debt that they can't pay off, and they don't have the higher education opportunity because they were unable to finish school. But in 2023, borrowers have an average of about $37,000 in federal student loan debt and $55,000 in private student loan debt. There are a variety of options for receiving federal loan forgiveness, including the Public Service Loan Forgiveness (PSLF) program, Teacher Loan Forgiveness Program, and Perkins Loan Cancellation. One second. Yeah. So because of the Public Service Loan Forgiveness Program, as of March 2023, there were about 3 million PSL applications processed, according to the federal student aid. In May 2023, the Department of Education announced that more than 600,000 borrowers had a total of $42 billion forgiven through the program. And this was a result of changes made by the Biden-Harris administration. So back to Pell Grants. The U.S. Department of Education released a transition program. So to smooth back the transition to repayment, the Department of Education promised to provide up to $20,000 in debt relief to Pell Grant recipients with loans and then up to $10,000 in relief to non-Pell Grant recipients. Borrowers were eligible for this relief if their individual income was less than $125,000 or $250,000 for households. And then the public service loan forgiveness program can be eligible if they're employed by nonprofits, the military, federal, state, tribal, or local government. And then if you didn't get your loans forgiven by public service loan forgiveness program, you can also, typically there's a income based repayment plan. There's different ones, but the typical 4 ones are pay as you earn. Now these have been in place since the 90s, but these are the current ones in place, and I'll get to the ones that Biden-Harris are proposing for right now. But pay as you earn is payments are 10% of discretionary income. Never more what you pay on a standard 10-year plan with forgiveness after 20 years. Revised pay as you earn, so repay payments are 10% of discretionary income, no cap on amount, with forgiveness after 20 years for undergraduate loans or 25 years from graduate loans. There's income-based repayment, IBR, for loans made on or after July 1st, 2014. Payments are 10% of discretionary income with forgiveness after 20 years. For loans made before July 1st, 2014, payments are 15% of discretionary income with forgiveness after 25 years. Payments on this plan are never more than what you pay on a standard 10-year plan. And income congruent repayment, payments are 20% of discretionary income, what you pay on a 12-year base plan with fixed payments with forgiveness after 25 years. So those are the typical 4 plans within the federal government, but the Biden-Harris administration has proposed a new rule to create a new income-driven repayment plan that will claims it will reduce future monthly payments for lower and middle income borrowers. The draft would require borrowers to pay no more than 5% of their discretionary income monthly on undergraduate loans. This is down from the 10% that we heard earlier. It would raise the amount of income that is considered non-discretionary income, and therefore is protected from repayment, guaranteeing that no borrower earning under 225% of the federal poverty level, about the annual equivalent of a $15 minimum wage for a single borrower, will have to make the monthly payment. Forgive loan balances after 10 years of payments instead of 20 years for borrowers with loan balances of $12,000 or less, and cover the borrower's unpaid monthly interest. So unlike other existing income-driven repayment plans, no borrower's loan balance will grow as long as they make their monthly payments, even when that monthly payment is 0, because their income is so low. So the Biden-Harris administration is rolling out these new plans for borrowers, about 40 million people in the United States, which is a substantial amount of our population, to ease their burdens, especially in this time of inflation and the job market. So it will theoretically try to help borrowers as much as they can in order to continue economic growth within the country. Because if you have borrowers taking out debt for 20, 25 years, especially low income people, they're going to struggle for those 20 years to make those payments. And then if they're focusing too much on repaying their debt, they can't stimulate the economy because they're cutting costs in order to pay the debt. So basically, this whole loan forgiveness program is supposed to be like in the interest of the country, because if more people spend, we'll have greater economic growth in the country. Our gross income will go up, and hopefully bring about, economic prosperity. Or that's what they're hoping with these plans. But the problem with student loan debt, and has been for the last, as you heard, 15 years, is that it may have been manageable in 1965 to get these loans and pay off your debt within a reasonable amount of time, just because there was less of it. So $40,000 in debt average for a public institution, that's what the average borrower holds, is a pretty significant chunk, especially if you're paying interest rates on top of that. And if you're only making minimum wage within New Jersey, I mean, that's a $15 minimum wage. But if you're not making that, even in like a different state, say if you're only on the federal minimum wage, which is, I believe, only about $7.25, there's like no way that you're going to repay these loans without defaulting on them, or just declaring bankruptcy or anything else. So this is like a large problem within the population. Prices have increased considerably in the last 20 years, while wages haven't. So as college gets more expensive, it was like easier to pay back your loans, say 30 years ago, because you had about the same salary that you're making right now, and you had, a third of the debt. So, what are you supposed to do if you're a student loan borrower, and you're worried about your monthly payments? I definitely recommend checking out if you're eligible for any programs that will make your life easier. It is always better to check out if you're eligible, and try to get on to some type of income-driven repayment plan rather than not, and be saddled with this overwhelming like monthly repayment plan, rather than just like seeking out what your options are. And obviously, if you're interested in, if you think the federal government does have responsibility to forgive some student loans due to the financial environment currently in America, I mean, I always recommend you contacting your representatives. Citizens are responsible for what the representatives care about. So if you make it known to your representative that you care about student loan relief, and you share your opinion with them, it may not change their opinion if like they're anti loan forgiveness, but at least you're making your voice heard. And if there's more people saying, hey, we want this is what citizens need right now, they're more inclined to listen. So that is definitely my advice, to contact your representatives, If you're voting today, you could be voting those representatives in. So, like, your representatives do have a responsibility to you as your constituent. And if you're concerned about student loan relief, and if you want to see new bills put forth to solve the problem, um, then just make your voice heard. Write that email or call that representative office. Basically, I would probably write the email just because you're not stuck on the phone. But um, do contact your representatives just about the issues that you think are important to you, because just because you may not think a lot of people share your opinion, maybe you, by sharing your opinion, could help other people also share their opinion about it, and build up a movement, I guess, for student loan debt relief. But that's basically what I had for today. I know it wasn't quite so positive or interesting, but student debt is a large problem, and while it is quite boring to hear about interest rates or like lending agreements or how much money student loans uh, the whole country has, and how the government um, isn't really assisting in the best way it can be. um, you know it does impact a big part of our lives, and because we go to a public university, or I do, and I assume most of the listeners on this podcast do, as I assume most of you are from NJT. It is something that we all have to consider, whether you're, even if you don't have loans right now for undergraduate, if you want to go into graduate, or if you want, uh, or even like different kinds of loans. If you have student debt loans and then you take on more debt for like a house or a car or anything else, you do need to consider how you're going to repay that. So I will be back next week with something. I think I'm going to do a funny segment next week. Maybe like the most obscure laws in New Jersey, because there are quite a few that I have been wanting to comment on, but I just thought, these are pretty key issues that I've tried to talk about, and try to bring like awareness of, and just make you a bit more informed about what's going on. So anyway, enjoy election day. If you haven't voted, again, please vote. Um, and stay informed on everything that's going on in New Jersey, federally, globally. But remember to take some self-care and make sure that you have the energy to support the causes that you want to support. Okay. This is Liz again out. I'll see you again next week. Thanks.